The granddaddy of gold ETF turns 20 today. The Spider Gold shares, or GLD as it's called today, went public at the New York Stock Exchange on November 18, 2004. For the first time, gold could be owned and traded intraday, just like a stock. It was the first commodity ETF, and it revolutionized gold investing. Today, it is the largest gold ETF with roughly $75 billion in assets. To understand how revolutionary this was, take a look at this clip from the very first day of trading 20 years ago.
Normally I talk about the stock market. Today we're going to talk about something totally different. I'm going to talk about this. This is gold. This is a gold bullion bar here. It's 25 pounds. It's worth about $180,000, and I've got 3 of them here along with a lot smaller amounts of gold, as well as these 2 burly guards I've been married to for the last half hour. Thank you, guys. Why am I talking about gold today? Because finally a gold ETF is available. Today, for the first time, thanks to the World Gold Council and State Street, you are able to buy gold just like it's a stock.
And I not only had gold, I had brown hair back then. I don't know what's happened. But let's talk about this with the founder of GLD. George Milling Stanley is with us. He was with the World Gold Council when it launched the GLD in 2004. He's now Chief Gold Strategist with State Street Global Advisors. They run the GLD. Also joining us here, my friend at the NYSE, Todd Sohn, Head of ETFs for Strategas. George, you saw the clip I just ran. You might recall you were supposed to meet me at the New York Stock Exchange. I needle him about this all the time. But you were supposed to be with me right standing next to me. You backed out because there was fears that the SEC would somehow ding you for violating securities law for promoting the GLD. We've come a long way since that. Things have changed.
Oh, I think we're all above ground now, right? No question.
You know what's amazing? That gold bar I held up, that was 25 pounds. At that time was $180,000.
Right.
What's that gold bar worth today?
That's now worth more than $1 million.
$1 million.
Yep, absolutely.
How things have changed. That's quite remarkable.
It's amazing how heavy 400 ounces is too, Bob. I noticed the struggle with which
25
you were holding
pounds.
that up.
Yeah, that's a lot. I think the most important thing, it was not just that suddenly you could buy gold, but suddenly commodity ETFs were viable. Of course, there was questions about where do they store the stuff behind it. But this paved the way for a lot of things after that.
Oh, yeah.
I mean, dramatically. So we had oil ETFs after that. We had other kinds of currency ETFs come after that. How has the gold ETF changed the investor base for gold? Compare 2004, who owned gold then, compared today?
Yeah. Investment demand in 2004 was about 10% of total end user demand. Jewelry was the lion's share, was 80% or even more at that time. Now jewelry's down to about 50% of the total. Investment's gone from around 10% to 25, 30, sometimes even as much as 40%. That's always the big variable in the gold demand side. That's been a huge, huge change.
And when you say investor demand, you're talking about demand for gold bars as well as ETFs. One thing that's changed too is central banks. Central banks were not really a big factor, and now they are. They're about 15% here. Yes. So why are central banks buying? What's their experience?
It's mostly emerging market central banks, and most of them, on average, they still have more than 2/3 of their official reserves in dollar-denominated debt instruments, which is a dangerous overexposure to one currency. And on average, they have less than 5% of their reserves in gold, which is a lot less than most of their populations would put into gold.
So it's a diversifier. Even if central banks want to diversify, that seems to be what you're saying.
Absolutely, absolutely. They don't want to be all in. You don't put all your eggs in one basket, right? You don't put all of your reserves into one currency.
Yeah, and just on the jewelry side. Lion's share of the demand is consumers in India and China. They consume gold they consider it part of their household net worth, right?
Correct.
How is gold demand in China and India right now amongst consumers?
Okay, China was going like an express train in the early part of this year, slowed down a little bit in the summer. That's often a seasonality that we notice, but it seems to be picking up again now that the government has put money behind the talk about stimulating the economy, and if that spreads into prosperity throughout the country, that will be good for gold jewelry. India, in the budget earlier this year, they cut tariffs, import tariffs on gold. They also cut capital gains tax on gold. So that again is going like an express train. And we still have some months of the marriage season to go, so that's doing very, very well right now.
So you can see these tailwinds we've got up here. I mean, you can see this is why gold's at a new high. You can understand why we're at a new high here. And the investor base is strong. The central bank purchases are strong. The consumer in China and India are still buying. I want to talk about Bitcoin in a minute, but how is the supply side? Is gold production increasing or decreasing? Is that fairly constant?
Gold mine production tends to go up 1% a year or down 1% a year. It really doesn't vary that much. You might hear at the end of this year that the gold mine production has reached an all-time record high, but it'll only be 1 or 2% higher than it was last year, so it doesn't really make a big difference. The big variable, as I say, is investment.
Yes, the demand side. So gold's hit a rough patch recently. I mean, we had new highs going into the election, and it slipped about 15% since the election. Can you explain what's going on there?
Yeah, I think investors have gone gung-ho on risk-on assets. This is why we've seen the stock market go up dramatically, why we've seen the cryptocurrencies go up dramatically. I think this is all representative of a risk-on attitude. And of course, gold, as you know, is the ultra risk-off asset. But gold's starting to claw back. It was back above 2,600 earlier this morning. I think it's starting to claw back some of the lost ground. I think things are looking good for the rest of this year and for next year too.
Yeah, Todd, the GLD was one of the great successes. At that time, 2004, it was still a fairly young history of exchange-traded funds. Yeah. It was the start of a wave of non-equity ETFs. We had the first crude oil ETF, USO, that was in 2006. That began trading. Then we had currency ETFs come after that in 2005, what was around. And then we had leverage and inverse products in 2006. And then with Bitcoin recently. Tell us your thoughts about the success of these commodity ETFs since then.
Well, I think it's somewhat funny that you mentioned George wasn't there with you when you introduced the gold bar, and you think about 2004, this was before Facebook, X, Twitter, social media was not there. Now you can just go out on social media and basically promote whatever you want. So it's just funny how times have changed. But ETFs are all about access, right? No matter what your end game is, gold allowed you to add something to your portfolio besides an equity and a fixed income instrument. So you can get diversification, as George mentioned. I think it is interesting that gold, GLD, since inception has outperformed the Russell 2000 small cap index, for what that's worth. So you talk about diversification. You could have just been in large caps, some fixed income and GLD, you've been great. So I think it's wonderful. The flows have been interesting recently. You've picked up, I think retail finally started to take notice that gold was acting much stronger than perhaps perceived. But technically speaking, yeah, you were a little bit extended. Now you're mean reverting here to perhaps reset.
Now you follow ETF flows. You're sort of the master of this, which is why we have them on all the time. GLD had huge inflows after July, but October, November started seeing outflows in the last few weeks in particular.
Yeah.
I don't know if one a technical analysis, but can this respond to these sort of oversold conditions? Is there a prolonged corrective environment ahead of us? I don't know.
Here's the tricky part, right? Gold was trading very extended from its 200-day moving average, right? You're just a simple measure of trend. And historically, you do get corrections from there. Now the question is, and I would lean more on George's fundamental knowledge of what's going on here, is do you respond to the oversold condition and continue higher? Or do you enter a more prolonged corrective environment like you did back in, say, 2004, 2009-ish or so? There are two other variables here, though. What does the dollar do? And what do real rates do? If those continue to push higher, that's not going to be a great backdrop for gold. If you can get the dollar and real rates to cool off here, that's going to be great for the metal coming into next year.